Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Now this is the last and final video on risk management. Last three videos I've explained you about what is the meaning of the term risk, what is enterprise risk, what are the different types of risks, and last video I've explained risk identification and risk assessment. So in this video, I'm going to explain you the last topic, that is risk mitigation strategies and managing risk. How to manage the risk, how to mitigate the losses on account of a risk. So all these are related with one another. So I suggest you don't skip any video. Watch all the videos to get the perfect knowledge about risk management. So if you have not watched the earlier videos, I suggest you go to the playlist of my channel, select the subject Financial Decision Making 2. Select the videos of unit number 3, risk management. Be clear regarding the concept of risk. So before explaining further, take the screenshot of the points which I have written on the board, then I'll explain every point. Now, the topic is risk mitigation strategies. Mitigation means reducing the severity of risk. So, what are the different strategies available to mitigate the losses of risk? The main objective of risk management is to control the risk. That means every business, risk is an integral part of every business. We cannot eliminate it. It is there. Our job, the business job, is to reduce the severity of risk. Hence, in every organization, there is a return, there is a risk. Wherever there is a return, there is risk. That means risk and return will go direct relationship. The direct relationship between risk and return. Higher the risk, higher the return. If a business takes more risk, its return will be more. If a business does not want to take the risk, the return will be lower. Higher expectation of rewards. If a business expects higher rewards, it has to take higher levels of risk, then it will get higher returns. So there is a relationship. Higher expectation means higher levels of risk they have to take. When they take higher levels of risk, they will get higher returns. If the returns are higher, then it is advisable to take higher risk. Now, risk is borne by every organization. Whether individuals are there, corporates are there, partnership, any form of business, we have the risk. The following are the various methods and approaches. Actually, our topic is what are the strategies available to mitigate the loss of risk. Different approaches are there, different methods are there through which a business organization can mitigate the losses. What are the different methods? We classify the methods into three categories. The first one, risk control. Second one, risk financing. And third one, internal risk reduction. So if we broadly classify the methods of controlling the risk or mitigating the risk as three. One by one we'll discuss. The first one is risk control. The risk can be controlled in two ways. The first, risk avoidance, and second one is loss control. These are the two methods of risk control. The first, risk avoidance. The simple method to control the risk is to avoid the risk. Don't take the risky activities. Don't produce the risky products. Don't involve in risky activities. Avoid the risk. As far as possible, avoid the risk. But present situation, if we avoid the risk, we will forego the returns. We will not get much returns if we avoid the risk. But the simple strategy, if a small business is there, the business does not want to take any risk, they can go for risk avoidance strategy. Means not getting involved in any such activity which contains risk. Secondly, loss control. Loss control focuses on two activities, that is frequency and severity of losses. Loss control is the second method. In this, we have two strategies. The first strategy is frequency. Frequency of risks should be reduced. Second, severity of risk should be reduced. Hence, it has two objectives. There is loss prevention and loss reduction. So for these two, that is frequency and severity, we have loss prevention and loss reduction. Loss prevention concentrates on controlling the frequency of losses. That is in terms to prevent the regular loss from recurring. So this loss prevention means controlling the frequency of the events which occurs losses. The business organization will see which are the events which are frequently occurring. So they want to prevent those frequently occurring events to incur the loss. Secondly, loss reduction pays attention to reduce the severity of the loss when event occurs, because we cannot avoid the events, risky events. Risky events will be there, but the business will focus on reducing the severity of loss from that event. So loss prevention and loss reduction, these two will come under loss control. So first method, risk control, in which I have explained you about risk avoidance and loss control. The first part completed, risk control. The second strategy of mitigating the loss is risk financing. So when funds have been acquired to cover the incurred losses, it is termed as loss of risk financing. That means business organization will spend some fund in order to protect the business from bigger loss. If some funds are used, the funds are invested in order to reduce the severity of loss. That is called risk financing. That means business organization is keeping a part or investing some amount in order to reduce the severity of loss. Now, there are four methods to cover the financing risk. This financing loss can be reduced by four methods. The first one is retention. That means don't incur any expenditure to protect the loss. Similarly, we'll retain the loss. The business organization says why to spend the money in order to protect the business from loss? Because it's outflow. We will take care of ourselves. We will not spend any money to protect the loss. That is called loss retention, keeping the loss with itself. That means the loss will not be parted with any other body. So sometimes it becomes very difficult to reduce the loss of risk. Under such circumstances, any businesses firm tends to hold a part or the whole of the given risk. They will not part away the complete loss, or they will not part away the partial loss. It will retain the loss. This is the first strategy. Second one is insurance. This is the most practically followed technique of reducing the risk of loss, insuring. The business organization will take an insurance policy from the insurance company by paying the premium. Example, a business organization is having a huge stock of goods. If something happens like fire or flood or any natural calamity, he will incur a huge loss because so much of funds are invested in the stock. There is a risk of loss. So the company will enter into an insurance company. Insurance company will say, we will protect your goods in return for a payment called premium. The company will pay premium to the insurer. Insurer is the company. Insurance company is the insurer. So for example, I am the insured, I am the businessman. I approached insurance company and asked to take the policy, to give the policy. The insurance company will say, okay, for 1 year you have to pay 2 lakh rupees as premium. So I have paid 2 lakh rupees to the insurance company to take up the risk. That means the risk will be transferred from the business to the insurance company. If the event happens, if fire occurred or any natural calamity occurred, in that case, the insurance company will reimburse the amount, will repay the amount of loss. Will repay the amount of loss. So I'm protected. I've protected the business from loss by taking an insurance policy. This is the second method. Third, hedging. Hedging means protecting the business against a loss. Against a loss. So that is called hedging. So nowadays hedging can be done by derivatives, by entering into derivatives market. A derivative is a financial instrument which derives its value from the value of underlying asset. So every asset we can make a financial instrument. The underlying asset may be stock, maybe goods, maybe commodities, maybe foreign exchange, maybe stock index. All these are the underlying instrument. On the basis of underlying instrument, a financial agreement is made. Financial agreement is made. That financial agreement is called derivative. Example, I am the exporter or importer. Frequently I will deal in foreign currency, but the foreign currency rates are fluctuating. In that case, I am exposed to risk, foreign exchange risk. So I will enter into an agreement with a banker that after 3 months I am going to get so and so dollars. I want to sell the so and so dollars. At what rate you are agreeing to buy? The buyer will say, we will agree to buy at 81 rupees. So now itself I enter into an agreement that after 3 months I am going to sell the dollar at 81 and the banker is ready to buy at 81. So we already made an agreement with the buyer. This is derivative. This is derivative. So in order to protect my business, I entered into a derivative agreement. This agreement is based on the foreign exchange currency. The foreign exchange currency is called underlying instrument. So entering into derivative market is called hedging. So hedging, the various strategies to reduce the risk for the derivatives are forward, future, option, swaps. There are many derivative instruments: forward contract, futures contract, options contract, swaps. These are all the derivatives, different forms of derivatives. And a business organization will enter into a derivative market to protect the business. That is called hedging. With the help of this. So next one is other contractual risks. There are other methods also where we incur some amount and part away the risk to another party. Apart from insurance, a business organization will enter into another business organization where there is an agreement. Example, ABC company, XYZ company. ABC company is having huge risk. They will ask XYZ company, will you take away some of our risk by paying some amount? So ABC company will pay certain amount to XYZ company and part away the risk to XYZ company. Now the risk has been transferred by ABC company to XYZ company by paying the amount. This is called other contractual risk. In this approach, firm transfers the risk to the other parties who are willing to take up the risk, and in return they charge a certain amount. These contracts are called hold harmless agreements. These private contracts between two companies to transfer the risk by paying certain amount is called hold harmless agreement. That's two methods I have completed. The first method is risk control and the second method is risk financing. Third and the last method is internal risk reduction. The business organization internally will reduce the risk by resorting to some activities. What are the activities? Risk can be reduced internally through two major forms. The first form is diversification. Nowadays, most of the businesses are diversifying the activities. They are not indulging only in one activity. They are spreading the activity. Like for example, LG, one of the multinational MNC is there. It is not producing a single product. LG is producing so many varied type of products. Similarly, other companies, number of other companies, they are not dealing in one product. They are dealing in different types of products. This is called diversification, spreading the activities. Why? Why the business is not dealing only in one activity? Why the business is dealing in different activities? The reason is to reduce the risk. We are spreading the activity. Suppose a business organization makes 5 products, A, B, C, D, E. 5 products it is manufacturing and selling. Why 5 products? Why not only one product? Because if they produce only one product, if something happens, the business will collapse. But if the business produces 5 products, if any one of the product incur loss, the other products may give the profit. The business can survive. The business can sustain the loss. That is called diversification. One proverb is there, one saying is there, don't put all eggs in one basket. If something happens, all the eggs will get destroyed. So in order to reduce the risk, you have to spread the eggs in different baskets, so that if any one of the basket is dropped or destroyed, the other baskets are safe. Because diversification, spreading, that is one of the method, internal loss reduction method. That is diversification. Next one is investment in information. See here, we can control the risk only when we have the information. Information is very much required in order to reduce the risk. But information is not freely available. To get the information, some investment is required. So business organization internally should make some investment in collecting, in gathering the information, so that the right decisions can be taken, so that the risk can be reduced. This is called investment in information. That's all. So totally 3 broad methods, that is risk control, risk financing, and internal cost risk reduction. These are the 3 methods which are called risk mitigation strategies. This marks the end of the topic risk management. Right? This is the end of unit number 3. Inshallah, in the next video, I'll take up the unit number 4, that is investment decisions. So if you are satisfied, give a like to the video, share my channel, give your comments, subscribe if you are not yet subscribed, and give your comments, and buy the super thanks which is given below my video. Inshallah, we'll take up the next unit in the next video.